let's get talking about fundamental analysis. Now, fundamental analysts study the core underlying elements that influence the economy of a particular entity, like a stock or a currency. It attempts to predict price action and trends by analyzing economic indicators. So it analyzes the economy, analyzes the sector, analyzes financial statements, and analyzes current valuation. Fundamental analysis can explain as a method of estimating security, which involved attempting to evaluate its basic value by assessing allied financial, economic, and other quantitative and qualitative factors. Now that was a mouthful, wasn't it? Fundamental analysis aims to study everything which affects the value of a security, including macroeconomic factors and company-specific factors. Now, you have to keep in mind that there are different types of fundamental or economic data that affects different types of assets. An earnings report is considered a fundamental report, but it wouldn't really affect the stock market or the currency market or the commodities market. It would tend to affect the individual stock. But if you had 4 or 5 retailers releasing bad earnings, that could have an overall effect on the indices. So this analysis method is taken as the opposite of technical analysis. As explained by Investopedia, fundamental analysis aims at using real data to evaluate the value of a security. Even though most analysts use fundamental analysis to evaluate stocks, this technique can be used for almost any type of security. Well, when we're looking at stocks, we're looking at things like return on investment, earnings per share. Okay? It's very specific and very related. When we're looking at economic events such as the jobs report or unemployment or inflation, that has a more direct effect on the currency value, but it has a secondary effect on the value of stocks, on the value of indices, and on the value of commodities. If the US dollar takes a dive, what will happen to oil? Okay, well, the price of oil will naturally go up because it'll take more dollars to buy the oil. So the main goal of carrying out fundamental analysis is to generate a value that an investor can weigh against the current price, with the real goal of outlining the type of position to take with that security. In terms of stocks, fundamental analysis emphasizes on financial statements of the company being assessed, and especially press releases. Fundamental analysis can be illustrated as an example mentioned ahead. Let us assume that an investor can execute fundamental analysis on the value of a bond by looking at economic factors, including interest rates, the overall state of the economy, as well as information about the bond issuer, like potential changes in credit ratings. For evaluating stocks, this method involves the use of revenues, future growth, earnings, return on equity, profit margins, and other data to determine the underlying value and the possibility of future growth. Now, keep in mind, fundamental data does not give you an entry point or an exit point. It doesn't tie directly back to the price that an asset is trading. It ties back to the value of that asset. So fundamental analysis is a stock evaluation method used for financial and economic analysis to predict the movement of stock prices, predicting future price movement, predicting fair value, management evaluation, analysis, analyzing companies' financial strength, and determining a company's ability to beat competitors. So the stock market is a very particular place where you apply a certain set of rules. Just like if we were to look at fundamental analysis involving commodities, what do you think is going to happen with oil? OPEC meetings. OPEC meetings is a fundamentalist tool. War, uneasiness in the Gulf, uneasiness in the city. Okay. The weekly EIA oil report, the Wells report. All of those are the economic or fundamental data that affects a particular asset, such as this case is oil, or a freeze or a hurricane in Florida has a direct effect on the value and the price of orange juice. An FDA or USDA report on crop reports would do the same thing. A famine, a drought. These are fundamental pieces of data that affect commodities. So the goal of fundamental analysis is to make financial forecasts, and fundamental analysis is done on the historic and present data. Now, most of us are here because we're really more concerned with economic events and news that affects the currency market, the Forex market, because that's the big boys. Okay, so we're going to pass stocks, because stocks, you have to understand all the ins and outs of being able to read an earnings report. Okay, so although earnings are important, they can't really tell you anything by themselves. They don't identify how the market values the stock on their own. Now, there's all types of ratios that are applied to earnings reports. But if you want to wade in yourself, keep in mind that some of the most popular tools for fundamental analysis focus on earnings growth, value in the market. These are some of the factors you want to identify and include. So these include like income statements, balance sheets, cash flow, to help you determine market value of the asset. So what about the other markets? For the national economy, fundamental analysis might focus on economic data to assess the present and future growth of the economy. Fundamentalists do not heed the advice of random walkers and believe that markets are weak form efficient, but by believing that prices do not accurately reflect all available information, fundamental analysts look to capitalize on perceived price discrepancies. In other words, what the dollar is trading for and what the dollar is really worth at the moment. So the key concept in fundamental analysis for Forex traders is analyzing the market fundamentals, whether the underlying asset is a stock, bond, commodity, or Forex currency pair, remains a cornerstone of how trading decisions are made for many professional and retail traders. They're looking to see if we have a good economy or a bad economy. Well, that's not such an easy thing to determine. So we have all types of economic reports that try to help us understand what the situation is or what the economy is for a particular country. And the better the economy, the stronger their currency will be. The weaker their economy, the lower the currency will be. So this would help us value one currency against another. So for those who are not purely technical, performing sound fundamental analysis before initiating a trade can make a significant difference in the overall success of a trading position. For example, knowing how a currency pair may react to a major central bank decision before it is released and what the market is expected to happen by going through the basic Forex fundamental analysis process can be very helpful to a currency trader when establishing or liquidating a position. So fundamental analysis is one of two main methodologies for evaluating and forecast the movement in the currency exchange rate, as well as the prices of a security. So let me share with you a little presentation I put together, because it's very, very important to understand how all of this works together. Not just what too many people talk about, the NFP, the monthly jobs report out of the US. And they think it's an isolated piece of information. If they understand how it affects the central bank, how inflation is affected by it, how factory and factory reports and production reports all tie back together, because they all tie back eventually to central bank action. And understanding how these tie together and why the markets respond the way they do is very, very important.
Fundamental analysis involves studying the economics of a country and determining the effect this has on the value of its currency. There are economic indicators that traders can observe in order to determine the strength of an economy. They are released as reports at certain times, and they can be released weekly, monthly, or quarterly, depending on the report. If an economy is determined to be strong, foreign investors will seek investment opportunities in that country, because a strong economy is more likely to present opportunities, such as returns on real estate or the stock market. In order to invest capital into a country, an investor will first need to convert their capital into that country's currency. If it is therefore perceived that the economy will produce great returns for investment, then that country's currency will be more in demand, and hence the currency value will appreciate. So, if US investors wish to invest in the UK because the UK is showing a strong indication of a growing economy, the demand for the pound will increase, and so the value increases. If the economy is seen to be weak, then investors are likely to seek investment opportunities elsewhere in a stronger economy, withdraw capital, and convert it to the stronger economy's currency. The currency of the weak economy will depreciate in value because of the lower demand for it. So when economic reports are released, investors and traders will look for signs that an economy is either strong or not. Before these reports are released, there is a certain amount of speculation as to what they may be, and traders will buy or sell currencies in anticipation of these results. For example, if the majority of traders think the results of an economic report will be negative, they tend to sell the currency ahead of the release, causing the price to fall. When this happens, we refer to the markets as being priced in, meaning that by the time the event has taken place, the price has already changed as expected. If the actual results are very different to what was expected, then this tends to have a big impact on the price of the currency. Price action can become very volatile, as traders price in the new and unexpected results. After a news release, the markets can still be volatile, even if the results are as they were expected, as traders need time to find out what the most probable impact of the reported figure will be. Therefore, as a beginner, it is generally best you stay out of any trades before and just after the release. Once you have more experience, you can learn about news trading and specialize strategies for it. So far, you have learned that Forex fundamental analysis involves studying the economy to determine the effect it has on the value of a.
So basically, currency pairs tend to react sharply to the release of economic data and current geopolitical and local news events, especially when the results differ significantly from what was originally expected by the consensus of market opinions. This makes performing a fundamental market analysis of an economic release and events and their effects on the currency value when determining the direction of the market and the level of the future exchange rate. Fundamental analysis has traditionally been better suited for traders who operate on a longer time frame. But for those of us who are trading CFDs and Forex in short-term time frames, it offers a lot of opportunity because it does create market volatility. But that same market volatility also increases risk. So you have to understand what you're doing. There's many ways to trade these events. Some people take positions before and get out before the event actually happened. Some people wait for the market to finish absorbing the knee-jerk reaction and then decide which way to trade. The method involves analyzing a nation's overall economic strength in its interest rate, central bank monetary policy, money supply, trade, and current account balances, as well as the country's overall political stability. Nevertheless, some fundamental traders use short-term news trading strategies that generally operate right after the release of a major economic number, central bank rate decision, or news of major geopolitical events, such as a war or a natural disaster. But first, you have to understand which events are the top-rated events, because there's a lot of events that are, whether they're good, bad, or in between when they're released, don't have enough importance to the markets to create any type of market movement or volatility. Then we have events that even if they're right on the money, they still create temporary volatility. So these include interest rates, consumer price index, which is inflation, industrial production reports, unemployment and employment rates, gross domestic product, producers price index, and retail sales. So regardless of which analysis method best fits a trader's trading plan, research remains a key element in success. Now, the fact is there is no economic event, no news event that'll give you an entry point, a stop loss, an exit point, because no fundamental events talk about value. Okay. It's only using charting and technical analysis that will help you with your when to enter, when to exit, how the market's doing. To see if a market's taken position before an event, you'd have to be looking at a chart because you're not going to see that in any fundamental data. So the most useful tools for fundamental analysis consist of the economics calendar, the financial news media, and historic fundamental data. The economic calendar informs traders on the scheduled time and date of releases of major and minor economic data. Now, if you notice on your screen, under handouts, I've put together a handout for you called Trading the News and Economic Events. Okay, just click the download button and download this. There's no sign up, there's no password, there's no anything. It's just a guide that I put together for you. It's a PDF. Download it and read it at your time convenience, and it'll go over each one of these events and how important they are and the volatility they'll bring to the marketplace. So what we're going to do next is we're going to look at this economics calendar. So what we're looking at is actually tomorrow's economic calendar. Okay. Now, these economic calendars are available all over the internet. They're all the same because all the data is pushed out by data feeds from the releasing agencies. What is different is the graphic design, the colors, the order of the columns. But the data, like I said, comes from data releases. So we're going to real quickly go over how to read this calendar. So in the first column, and most reports are pretty much the same. Some, like I said, mix up the column. We have the time of the release. Then we'll see the country and the currency affected by this release. Oh, excuse me. I think winter is getting here. Then we're going to see an important feature. Okay, and again, it could be in this column. It could be over here on some of the calendars. Okay, but all economic data is rated, and they're standardized rating, and they come in what we call tiers. There's tier 1, tier 2, and tier 3 data. Now, first, let's stop and think. This economic data is statistical data released by countries in most cases, or private data collection agencies, but most of it's statistical data accumulated by a country. This data has been accumulated and released for 30, 40, 50 years, way before there was Forex trading, way before there was online trading. So the economics calendar is a fairly newly conceived idea. But what it does, it pulls all of the economic events that are happening around the globe or in a particular country that will affect the financial markets. Now, if you've ever read one of these economic reports, like let's stay with the non-farms payroll report. This is a huge report that's hundreds of pages long. And it isn't designed for the financial market. It is the statistical data every country needs. How many senior citizens were hired? How many students were hired? What regions were they hired? What type of jobs were they offered? What was their salary level? How many people were unemployed? What happened in nursing? What's happened in the East Coast and the West Coast and the Midwest and the East, and every state involved and every city involved? Because this is data that a lot of people need and that a country accumulates. Now, of this whole big report that's released, okay, we have what we call 4 headline events that affect or make a statement on the overall economy. One is how many total jobs were created. Okay? Not how many jobs in nursing and how many jobs in medical and how many jobs in retail how many jobs did the US create? The next is the unemployment number. What is the unemployment rate for the overall country? Then it's the hourly wage. And what we're concerned here is that the hourly wage is increasing steadily, and so is the amount of hours worked per week. And then there's what we call the market participation. Now, market participation during normal times isn't very important. Okay? Hours per week isn't that important. Okay? Except when we were in the financial crisis, this was very important because unemployment was going down. But what happened was lots of people that had high paying jobs that lost their job were taking other types of jobs. And so they were employed, but a man who was making $40,000 a year is now accepted a job making $20,000 a year. Okay. Or somebody who was entitled to unemployment or couldn't find a job in the market, but they're no longer on unemployment. They only stay in this unemployment category for so long. They've moved out of participating in the market. You know, they've gone for 3 months of hundreds of interviews and haven't gotten a job because they keep saying, well, you know, there's a financial crisis. So they stopped looking. Well, this affects the market participation rate. So these four events are all part of the major event, but each one of these pieces of data, these headlines, have an effect on the overall economic situation. So you can't take one without the other. Although the number of jobs created is what we call the top tier report, we react immediately to that top tier report. Unemployment stays pretty steady. Hopefully it's going down, but it moves by 1/10 of a point. And some months it's up or down 1/10 of a point. And it doesn't make that much difference because a lot of times it's a statistical anomaly. So understanding all this about the jobs report helps you make a better trading decision when it's released. But I divest. Okay. So, for instance, tomorrow, Australia is releasing their jobs report. So, see, we have, okay, let's go back to the bullheads. As I said, all of these reports, any report is rated. Tier 1, Tier 2, and Tier 3. Tier 3 being the most important. Now, investing.com uses bullheads. Some places use orange, red, and green. Some places use a 1, 2, or 3, or 3 stars, 2 stars, and 1 star, because this is up to the graphic designer for that site. Because all it does, in this case, this is a level 2 report, and when level 2 comes out, it tells the computer to put 2 bullheads. But tomorrow, we see in Australia, this is one report with 2 sub-reports. Okay. So what we do is, this is the most important of the report. That's why it's got 3 bullheads, or it's a level 3 volatility. These are 2 subsections, which is like the unemployment rate and the total employment change. And then this is how many new jobs they created. So you have to understand what the reports are telling you together. And you have to understand what the levels are. So we've got the time, the currency. We've got the tier, the volatility, sometimes it's called the impact, okay, level. Then we go into the center, which is always the name of the event. And every country around the world releases the same kind of data. It's just called different things in different places. In the UK, the jobs report's called the claimant count. In Australia, it's just called the employment change report. In the US, it's called the non-farms payroll report, which confuses the hell out of a lot of people. But because these reports were around so long ago, that in 30, 40, 50, actually pre-World War II, the USDA, US Department of Agriculture, was responsible for all the reporting and everything going on with farms and ranches. So all the farming and ranching data was handled by the USDA. The Government Bureau of Statistics, and which became the Employment Bureau, took care of everything else. So this report was originally called the non-farms payroll report because all the farming data came from the USDA. But that's historic things. These are things you would learn over time. But every country releases the same type of data. Now, one of the biggest advantages to the economics counter is it doesn't do any analysis. It's straight numbers, straight value. It's not looking saying, well, the economy is good, so it should be a higher number, or the economy is bad, so it should be a lower. It is strictly a number. This means you can then make your own evaluation of that number because nobody else has actually reevaluated it. So we've got the time, the currency, the volatility, the name of the report. Now, all calendars, when you go to the name of the report and click on it, it'll open up a window telling you the more details on that report, show you some charts on past events and everything else. Now we go to the important columns, and those are to the right. Almost always on the right column, the far right column, is what we call previous. This is the data that was released at the prior time this report was released. So we're looking at the Australian jobs report. It's released every month. So last month, they failed to create 19,000 jobs. It was a negative 19,000. That means the country created no jobs and lost jobs. But that's a fact. Last month, the employment change was a negative 10.3 thousand, but unemployment stayed the same. But this is what happened. It's what was, except because this is constant data that's constantly being analyzed. When the new report is released, so like tomorrow, when they release this report, they can release what they call revisions. Because this minus 19,000 could have been because the one person who handles it in the office was on holiday and she had a week off and nobody calculated the data. And believe me, this happens. Like in the US, always after a long holiday weekend and then the non-farm payroll report comes out, it's always fixed the next week because so many people are on holiday. The reports just, so say a big manufacturing company didn't send their data in to the department on time because somebody was off or somebody called in sick. These numbers can be swayed. So the next release, they'll release a revision to the previous report. But the previous was what was. Then we come to what we call the forecast or the consensus. This is one of the only numbers that isn't etched in stone. Because the government and most statistical agencies don't release guesses or estimates. They release data. So a lot of times you'll be reading in Bloomberg, our 1,000 economists estimate that we're expecting this report to come out at 140,000. Or our poll of 500, buying supervisors in 500 major plants have, told us this. So we've analyzed it. We expect the PMI report to be here because it's only a guesstimate. And then we get the new report. And the new report is the actual, and it is released today. Everybody gets it through data feeds simultaneously. So there's no rigging. And today, as a private trader, you get this information as fast as a hedge fund gets it. Now, that isn't etched in stone because a lot of these reports are from private agencies. And nobody's trying to pull the wool over your eyes. Okay. But when private agencies like Thomson Reuters or HSBC release a piece of data, they release it to their subscribers first. But if you go to their website, like I said, nobody's trying to pull the wool over your eyes. They'll tell you that they released the data 30 seconds to their subscribers. First, the subscribers paying tens of thousands of dollars a year for that number, and they're a big hedge fund or they're a big broker. Why shouldn't they get the number 30 seconds before? Okay. As long as there's people not deceiving you. Now, if you think of this data as a report card for the economy, okay, I'm going to tell you a story about the kids and their report cards. So you've got two kids. Your son's in high school, middle school, and you're sitting down to Sunday dinner and you say, well, kiddo, report cards are coming Wednesday. How did you do? Or how do you think you're going to do? Your son says to you, well, mom and dad, if you remember last report card, last quarter, I brought you home 4 C's and 4 C pluses. They said, yep, we remember. That is the same as the previous. Now, last semester when he brought you home 4 C's and 4 C pluses, you know this average. You'd like your kid to be brighter and smarter and put some more effort into it. You do the nice parental things. You give him a little bit of a lecture, a little pep talk and all that other stuff. You keep checking out his homework and his social studies and all that kind of stuff. Now, tonight is Sunday dinner. He gives you the forecast, his guesstimate of what he thinks his report card can be. Now, he's seen all of his quizzes. He knows how much he's participated in class. He knows how he's done on his exams. He knows how he's done on his papers. And he says, well, mom and dad, I really worked hard this semester or this quarter. I think I'll bring you home all C pluses. Well, as parents, that's not so bad. It's not so great, but it's better than it was last quarter. And for all C pluses means he's better than, or the top of average or slightly better than average than all the other students. So you're not disappointed, but this is only his guesstimate. Now, of course, being good parents, you give them the lecture about getting into university, a little bit less time on Facebook and social media, and a little bit more time studying. Now, come Wednesday, now what's happened is you've now set your anticipation on his all C pluses. Now, come Wednesday, he comes in from school, tosses his report card on the table, and goes out the back door to meet his friends. Well, you open up the envelope, and what do you look at? You're shocked. He got all B's, straight down the road. Well, you're thrilled. You're ecstatic. You holler out the back door, hey, kiddo, I'm going to take you to the mall. You can buy anything you want in the sporting goods shop, and then we'll have dinner in the food court. You pick whatever you want to be because you did really good. He says, thanks. You shut the door and you go to make arrangements to go to the mall. And why? Well, he did better than you expected. Now, you haven't gone back to the school and found out they changed the grading system. They changed the bell curve. They want to get some government money, so they need to do better on their testing. Whatever, you don't know. You just know B's are better than C pluses, and he got you all of them. And it's much better than you expected. So you have a very positive reaction. Now, a minute later, the soccer ball comes in the back picture window, shatters the glass, makes a mess in the house. Well, you open up the door, yell, hey, kiddo, get your butt in here, clean up the glass, call the handyman and get him to board up the window, and forget going to the mall. Well, this is what happens in the markets. 1 minute, some fundamental advice information can come out, and it can be very good. A few minutes later, some other report comes out that can be very bad, or some event happens that can be very bad. So the markets respond to knee-jerk reactions, and they can be up and down, because what you'll see if you start trading this calendar, that most of the major events are released either the first couple days of the month or the last couple days of the month. Middle of the month is pretty quiet. So, like tomorrow, we have a crazy day in the UK. We have now all of this is the central bank action. So we have Bank of England having a meeting, and then we have another major event, retail sales, and they're on the backs of each other. So retail sales can be really good and send the pound up, and then comments and changes from the BOE could send the pound right back down to below where it was. But the nice thing about the economics calendar and fundamental events is that you know way in advance what they're scheduled. You know a week in advance what the expectation is. So in other words, you had a chance on Sunday to talk to your son. And technically, if you wanted to talk to his teachers, talk to the other parents around the neighborhood and everything else before the report cards came out, you could have done that. You could have done all the studying you want in preparation for the event. But for short-term traders like us, we're only concerned with the knee-jerk reaction, because if this report was slightly better than expected, in other words, if he brought you home all C pluses but two Bs, slightly better than expected, but not enough to cause any type of reaction. So you have to evaluate what level or where it will be important enough, and the difference between the expectation and the actual, to cause a tradable event. And that takes a little bit of work, but you can do that work ahead of time. This is one of the few times in the marketplace in online trading that you know exactly what's going to happen, when it's going to happen, how it's going to happen, and you can prepare yourself ahead of time. Now, trading news, like headline news and political news, is a little bit different. If war breaks out in the Middle East, oil prices are going to skyrocket. If they discover a new natural gas wells, or develop a new technique to take out oil, oil prices or natural gas prices will go up or down. When the markets go crazy, we get political upheavals. Gold will go up, the yen will go up, because these are called safe havens. So there's lots of fundamental analysis indicators that can be used to help us make some type of trading decision, because nothing in the fundamental analysis will tell you what price to get in the market point, what price to get out of the market. So remember, the most important reports are the jobs report, trade balance, current account, GDP, CPI, which is inflation, PPI, which is Producers Price Index, which is also inflation, PMI, which is Purchasing Managers Index, and commodity prices. Because if commodity prices go up, it's going to have an effect on factories, PMI, because all their costs will go up. Oil goes up, it'll have a long-term effect on retail sales. Because the price of goods will have to go up. The price of goods go up because oil for plastics is higher and the trucking costs are higher. Then you'll see retail sales ease, but you'll see inflation climb, because they all eventually come back to affect monetary policy. And that is what is so important. So let's take a look at a little presentation of how all this circles back.
Indicators measure how strong an economy is. It is important to understand how strong an economy is, because the strength of an economy has an impact on the value of the currency. These indicators are released as reports, and the publishing times are released ahead of the actual publication. Interest rates are one of the most important drivers of the currency markets. They are normally set by a country's central bank. For the United States, interest rates are set by the Federal Reserve Bank, and for the Eurozone, the European Central Bank is responsible for setting the interest rates. The central banks use the interest rates to promote economic growth or to curb inflation. Let's take a look at the mechanisms behind this. The central bank of a country lends money to commercial banks, and the interest rates set by the central bank are what the commercial banks have to pay for borrowing the money. This is referred to as the base interest rate. These commercial banks also lend money to people that want to buy things, such as a house. The minimum interest they have to pay is the minimum based on the interest the central bank has set. So, if the central bank changes the interest rate a commercial bank charges also changes. Now let's have a closer look at how the interest rates specifically affect a country's currency. When the central bank increases the interest rates, the cost of borrowing goes up. This means that homeowners now have to pay more on their mortgages and, as an effect, have less money to spend on commercial goods. Therefore, the demand for these goods, like cars, will go down. Manufacturers are now faced with a lower demand for their goods and are not able to raise the price that much. Therefore, raising interest rates will curb the economy by decreasing the demand for goods and services and will reduce inflation. However, when the economy is not doing so well, the central bank might want to decrease the interest rates to stimulate the economy. Now, when the interest rates are lower, a homeowner spends less on his mortgage and therefore has more money to buy other goods and services like cars. These goods need to be produced, so by lowering interest rates, production will rise and thereby stimulate economic growth. Of course, it is not just mortgages that are affected by interest rates. Factories and other areas of industry borrow money to invest in growth. When interest rates are low, the cost of borrowing is low. Business owners will be more inclined to grow their business and will therefore borrow money. This money is invested in the economy, spurting further growth. On the other hand, when interest rates rise, business owners will not continue to invest as much because it is more expensive for them to do so. The economy will slow down as a result of less money invested. A higher interest rate means that you gain higher rates of return for the money you hold in your savings account. This is also why higher interest rates benefit those who have savings. If one country has a higher interest rate than another country, money will flow into the country with the higher interest rate because investors will get more interest on their money. Because the country with the low interest rate currency has to be exchanged for the country with the higher interest rate currency, this increases the demand for the higher interest rate currency, and the currency appreciates in value. Inflation measures the rate at which prices of goods and services rise in a given period. If inflation is too high, prices increase significantly and therefore reduce the purchasing power of money. In other words, the disposable income that consumers have is reduced. This can have a negative effect on the economy and hence the currency. However, if a country experiences low inflation, prices become stagnant or rise too slowly. Investors could see this as an indication that the economy is not as strong. Therefore, this could also have a negative effect on the value of a currency. To protect consumers from excessive inflation, central banks will tend to raise interest rates. This is because it reduces the spending power that consumers have, and so there is reduced demand for goods and services. Under reduced demand, the price for goods and services are kept to an optimal rate. When inflationary data is higher than expected, traders may buy the currency of a country in anticipation of an interest rate hike from the central bank. However, it depends on the economic conditions because excessive inflation could erode the value of any capital within that economy, which means that the value of the currency could decline.
So as you can see, trading fundamental analysis gives a Forex trader a deeper understanding of how the markets react to a variety of events. Nevertheless, having knowledge of technical analysis along with fundamentals can give a trader a significant edge over a trader that only uses one methodology. Fundamental trading involves taking shorter term Forex positions, can also make sense where the trading plan allows for wider swings in the market. Some traders might buy option combinations like straddles or hedges with both calls and puts to capitalize on the brief volatility, often seen immediately after the release of a number. Long-term Forex position traders evaluate a country's economic releases over a more extended period of time. So regardless of whether you are a short-term or long-term trader, applying sound fundamental analysis can help guide you in your overall trade decision success. So I'd like to thank you very much for joining us tonight. If you have any questions, if you go to www.avatrade.com and check out their education materials, or if you still don't have an answer, if you use their live chat or send them an email, they'll be more than glad to hook you up with an individual financial analyst who will actually explain and answer all of your questions one-on-one. So thank you very much for joining us tonight. I hope to see you in our future webinars. And once again, if you want to see a recorded version of this class, use the same link you used to come to tonight's class, or when investing.com has had time to edit it and clean it up, you'll be able to find it on the investing.com website under education and webinars on demand. So I'd like to wish everybody a happy and healthy new year as we move into the holiday season, and we'll be seeing you again before the year's over. Have a great weekend. Bye now.